The Bank of Japan kept interest rates unchanged Tuesday and said it would taper its purchase of government bonds at a slower pace amid concerns about the effect of trade uncertainty on the world's number 4 economy. The central bank spent years buying up Japanese government bonds, JGBs, to keep yields low as part of an ultra-loose monetary policy aimed at banishing stagnation and harmful deflation. But it began moving away from that program last year as inflation began to pick up and the yen weakened, and hiked interest rates for the first time since 2007 and began winding down its JGB purchases. It has since then lifted borrowing costs several times to 0.5%, their highest level in 17 years, and continued to buy fewer bonds. However, analysts say uncertainty sparked by US President Donald Trump's trade war has led officials to hold off more hikes, and on Tuesday they held rates again, while saying they would slow the pace of JGB reductions. Purchases will be cut in principle by about 200 billion yen each calendar quarter from April-June 2026 from around 400 billion yen, $2.8 billion per quarter. Carol Kong, an analyst at the Commonwealth Bank of Australia, outlined the possible reasons for the decision ahead of the release of the BOJ policy statement. Slowing the bond taper will help keep interest rates lower than otherwise, providing support to the economy amid heightened trade uncertainty, she told AFP. Speculation of such a move intensified after a surge in the super long Japanese government bond, JGB, yields in recent months. Kong added. The yen weakened on Tuesday, with the dollar buying 144.80 yen around midday, compared with around 144.30 yen on Monday, with the BOJ's main rate much lower than the US Federal Reserve's 4.25 to 4.5%. The recent softening of the yen could already partly reflect expectations for a cautious policy update from the BOJ, alongside negative spillovers for Japan from the Middle East conflict. Lee Hardman of MUFG had said before the decision. Next rate hike. The BOJ also highlighted the risks ahead for the economy, saying growth is likely to moderate as trade and other policies in each jurisdiction lead to a slowdown in overseas economies and to a decline in domestic corporate profits and other factors. However, factors such as accommodative financial conditions are expected to provide support, it added. Kong added that the bank will likely hold off on rate hikes until there is further clarity on US trade policy. Japan, a key US ally and its biggest investor, is subject to the same 10% baseline tariffs imposed on most nations plus steeper levies on cars, steel and aluminium. Trump also announced an additional 24% reciprocal tariff on the country's goods in early April, but later paused it along with similar measures on other trading partners. Prime Minister Shigeru Ishiba said Monday there had been no breakthrough on a trade. The Bank of Japan's, BOJ, recent decision to keep interest rates unchanged and slow down its bond tapering may seem far removed from Iraq and the Iraqi Dinar, IQD. But in the interconnected global economy, there are several indirect channels of influence worth understanding, especially when analyzing global monetary dynamics, trade flows and currency stability. Here's how it could relate to the Iraqi dinar. Counterclockwise arrows 1. Global monetary policy coordination and capital flows. BOJ's dovish stance, keeping rates low, contrasts sharply with the US Federal Reserve's higher rates, 4.25 to 4.5%. This contributes to a stronger US dollar and a weaker yen. The Iraqi dinar is heavily influenced by the US dollar, due to Iraq's dollar-pegged or managed float system and dollar-based oil sales. A stronger dollar generally means downward pressure on the IQD, more expensive imports for Iraq, strain on domestic inflation if the government relies more on imports, especially food and tech. Globe showing Europe, Africa too. Investor sentiment toward emerging markets like Iraq If Japan slows its monetary tightening while the Fed holds or cuts rates later, global investors may start shifting capital toward high-yielding or undervalued emerging markets. This could include Iraqi bonds or investments, especially as Iraq shows gradual economic recovery as forecasted by the World Bank. Improved capital inflows can support the IQD, encourage foreign direct investment (FDI), boost confidence in Iraq's financial stability. Oil drum #3. Trade uncertainty and oil prices. Japan is a major oil importer, and trade uncertainty, especially from Trump's tariff policies, can lower Japanese and global industrial activity, weakening oil demand. Lower oil demand equals downward pressure on oil prices. For Iraq, an oil-dependent economy, lower oil revenues can weaken government budget performance, affect reserves and fiscal policy, put pressure on the IQD, especially if the central bank needs to dip into reserves to defend it. Chart with downward trend for currency markets and safe haven effects. The yen's weakness might trigger broader movements in global FX markets, causing investors to favor the dollar further. Since Iraq pegs to the dollar, this could increase volatility in the black market exchange rate of the IQD. If domestic supply of dollars tightens. Summary: implications for the Iraqi dinar. Factor impact on Iraq IQD. BOJ rate pause and slow taper supports global low-rate environment. Stronger USD versus JPY pressure on IQD, higher import costs. Lower Japanese demand for oil potential hit to Iraqi oil revenues. Capital shift to EM's potential inflow, supportive of IQD. Trade war uncertainty caution in global investment flows, mixed. White heavy checkmark final take. The BOJ's move itself does not directly affect the Iraqi dinar, but its cascading effects on global interest rates, oil prices,